We talk about a roller coaster over the last few days, up and then down and then back up. We just keep kind of moving in a really, really noisy area of the markets. We're not really trending lower anymore. We're in a little bit of a convergence zone, but we're also not breaking out to the upside either. So I'm going to show you how far higher we need to go to get a good break that will sustain itself into a new run. Potentially the run that starts this correction bounce that leads up to new highs, right? I mean, it would actually set us up for this still just being a correction. I think that's a lower odd scenario, but that's still a scenario that's out there because we did not break 3,500. As we broke below that 200-week moving average just barely. We're back above the 200-week moving average, and now we're going to see how far up we can go. Where's that resistance level? What's the ramifications of it? Where's the resistance level after that? So we're going to break down kind of what we need to see and what we most likely will see by the end of the week that will tell us that, you know, whether or not we're going to make one last leg lower to the downside with maybe potentially more historically record-breaking oversold clusters before this intermediate run is done. So let's go ahead and get started. Today is Monday, October the 17th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get started, I invite you to subscribe to our YouTube channel with this icon here in the bottom right corner of your screen or the red subscribe button down below the video. Hit the thumbs up icon to like our video. Comment down there on anything that stood out to you. Join our website at MarketScholars.com with that link up there. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these things over here on the right, including all these classes we have upcoming. Come down here, click on the heart. We came really close, got to 92 likes. Came really close to getting back to 100, getting back over that hump again. Just hit that heart, it opens up this tab, hit that like button. Also click the thumbs up icon, opens up this tab, hit that like button. Again, the more you do that, again, it helps get our content out to all of our followers. All right, well, let's go ahead and get started and take a look at the S&P 500 with the market forecast indicator. You can see, obviously, we rallied today, up over 2.5%. It's our third straight day of a 2% gain or loss on the S&P. It's the first time that's happened since these 3 days right here, the 9th, 10th, and 13th. We had two straight 2% or more declines. So only the second time all year that we've had 3 straight days of 2% declines and or rallies. You know, it's some combination of that. So you got this 23% retracement level of this current intermediate decline that we're on right now. So we have not closed above that. And that's when anything between 0 and 23 is noise. So we don't really start to break above that. Let's make sure I have everything here. We don't really start to break above, we don't start to retrace until we break above that. So you can kind of get an idea that we kind of need to clear through this 3690 area for us to really start retracing this intermediate decline. Of course, that same level for the long-term decline is here at about 3,800, a little bit above 3,800 here. That's the 23% retracement of this long-term move. So we can go from here, you know, from the lows a couple days ago to 3,800 plus a few points, plus or minus a few points, and still just be noise on a long-term basis. Of course, at that point, you also have the 38% retracement of this current intermediate decline that will act as a resistance, first resistance of the retracement. You also have this black line, which is a 38% retracement of that post-COVID rally. So that we broke, it acted as a support. We had a fake out. It did not fake out the second time, so we have been below that for this whole time. So that's going to act as a resistance now. And then you have the 23% retracement level of the big long-term bull market run that we've been on since 2009 off of that low point. And of course, we had a fake out there too, and we are easily below that now. In fact, the 30-day moving average is below that. In fact, we are actually still easily below. Like, remember, the trend doesn't change until you get above 2.5% above that moving average. You have to get significantly enough above the moving average to get it to turn around and turn green. For the S&P, just anecdotally, based off of experience looking at the charts here, it seems to be about 2.5% in either direction. Of course, if you got 2.5% above the 30-day moving average, like tomorrow, considering where it's at right now, you'd say it's at right about let's see here, it would be 30, 37, 85, 40, 37, and it's going to be dropping, but you'd have to get up to 38.80 for us to get right now today 2.5% above or more. So that's right there. So we would have cleared all these lines. Of course, as that drops, this number will drop too, but it's not going to drop very much. You can already see the drop is declining. So we're going to have a really good sense of if and when we actually do start the next intermediate run to the upside, the green line. You know, at least right now, we have to break those levels for that to happen. Of course, by then you'd get you'd get green line. Your intermediate line will probably be about 50 at that point. Of course, for start a bullish intermediate run, it's got to get above 60. I think we will get above 20 easy. I think we will potentially get above 40. Maybe not. The market sentiment line's dropping pretty hard here. But I don't think we get into bullish territory on this current leg higher right now. I think we're going to still move up higher, right towards the moving average, towards 3,800. We might even get a little bit above the moving average, but not quite 2.5%. And then I think we have one last leg lower on this current intermediate decline before it's all said and done. So I think we'll retrace, hit the resistance, and then roll back down and continue lower. And before this intermediate run inside, I told you that this is only the third time in history that we've had 10 or more oversold clusters on the same intermediate decline. I don't think we're done. I think we'll get another oversold cluster or two before this decline's over with. But first, we're going to have a little bit of a rally. I think that will last most of this week. We'll get above this 3,700, in my opinion, and work our way up in this direction. The question is whether we'll get above that 38, 25-ish, whatever this number is, plus or minus a few points, right? But if we clearly get above 2.5%, if we get above that by the end of the week, I think that's far less likely, but that's what it would take for us to really turn the ship around, at least in the intermediate term, if not eventually the long term, right? You have to get to, you're going to have resistance at 4,000, both on the 62% retracement of this current intermediate decline, as well as the 38% retracement. So, 3,800 plus or minus a little bit, so really major resistance. But then you have another really major resistance level right above that. It also happens to be a very big round number. And of course, getting above the 50% retracement, which we've talked about before, is very famous level. A lot of people brought it up over here. You'd also be getting back above that 23% retracement of the post-COVID rally. You'd also be getting above the 78% retracement of, so get above 4,200, and now we are going. That's what it would take. That's literally what it would take for us to be, for us to feel really good about the markets being bullish from here on out. Otherwise, the more likely scenario is, and what I've always taught you is, you expect resistance or support to hold until it doesn't. So you have about as strong of a resistance as you can possibly have at 3,800 plus or minus a little bit. And then you have another pretty major resistance at 4,000. So you expect those to hold, especially the stronger they are, the more you expect them to hold until they don't, right? And then, of course, that last one would be around 4,200 there, where you'd be looking for a fake out again. And to see if, but again, usually when you get up to a level where you've had a fake out previously, it doesn't fake out the second time. It usually holds. Just like we've seen on the downside. We had a fake out over here, and we didn't fake out this time. It's held so far. So you can see that's how that's how they're all looking right now. The NASDAQ looks very similar. The Russell 2000 actually looks a little bit more bullish. It didn't get as many clusters on this little decline, this leg lower. But again, like the S&P, we are not above that 23% retracement level. So again, anything is noise until between 0 and 23. You don't start to retrace until after that, and then you've got resistance up here at about 1,800. Keep in mind for the Russell that these long-term levels, the black and red lines, are a little bit higher. So whereas they're a little bit closer on the S&P, they're a little bit further away on the Russell. The Russell's been more bearish for a longer period of time, even if it hasn't been as bearish on the current leg, on this current intermediate decline. Let's take a look at the long-term, the weekly chart. And you can see, as we talked about on Friday, we're probably going to get a higher close, and we did. So we got another higher close here, the beginnings of a transition candle. Of course, after this week is over, we have to close above the body of this candle to confirm the reversal. because it didn't do that here. We just continued lower. And I actually think that's going to be the case. I think we're going to finish with a pretty decent transition candle this week, but then the following week after expiration, I have a feeling we'll probably get that leg lower to the downside. You can also see some of the other oscillators. Let's look at the 3 green arrows first. Take a look at the 3 green arrow chart. We do not have red arrows. We have 2 greens in the S&P. We have 2 greens in the Qs. We have 2 greens on the diamonds. We have 2 greens in the Russell. Remember, it's not bullish until you have all 3, and then they have to stay there for more than just a day or 2. So we're nowhere near changing the trend. Remember how I said, when there's a gap between these moving averages, that it takes, if you don't get above both of them at the same time, it takes, you'll usually get above one and fill in space, and that's it. There's a pretty decent gap between the 17 and 30. There's a pretty decent gap between the 30 and the 50. So it's going to be hard to really get going until those gaps shrink. And usually that's what happens when you consolidate. And that's, the kind of pattern we're on right now. The MACD is above its moving average and heading higher. But we're not above the 17-day moving average, which is where the 23% line is. So we're still in kind of a convergence mode, which is not only kind of limiting the upside, but fortunately it's also limiting the downside right now. But you still have pretty bearish patterns on some of these other oscillators. We're not above 30 anymore, but we are still above 25 in the negative. We are way below 20 in the positive, nowhere near getting above 25 in the positive anytime soon. We are still in the lower half of the chart on the RSI. We're still right around the middle of the chart on the CCI. So not necessarily bearish, but not really bullish either. I did want to show you the whole moving average. We did get a reversal candle on Thursday, and that was confirmed with Friday's pattern. And then today we have a higher close again. We still don't have a green hull. We still don't have the parabolic star flipping. So again, don't put a whole lot of stock into this rally. I think by the time we do get those things, because 3,800 is up in here, right? That's where your resistance is. That's where I think we've kind of finished the short-term leg higher here. Let's look at the Bollinger Bands. You can see we're back into the middle. So we had been in the lowest quartile. We're back in the middle, but the bandwidth has really been falling. That's what happens when you get a high bandwidth that rolls over. You just start to consolidate. We're still consolidating until this gets down a little bit lower. We have started to move into the last 2 days. The Bollinger Bands have moved into the Keltner channels. So we had been trading outside the Keltner channel, which is trending. Now we're back in the Keltner channels, and now the Bollinger Bands are back in. So we're setting up for a breakout again. We had this really good breakout that started bullish and then flipped bearish without a consolidation. Well, now we've got this bearish breakout that we're consolidating. Now the question is, where is the next breakout going to be? Next time you get green dots, you get the green dot when the Bollinger Bands expand back outside of the Keltners. That, again, I don't think that will happen before the end of the week. I think it will happen more likely next week, and I think that move will be more than likely a leg lower to the downside. The VIX is still really muted. It's not really doing much of anything. It is down. It did form. It's below 100%. It has been for a long time. We have these patterns here. I told you we're bearish when you start above 105, close below 100. So we're kind of double topping. I think we're still waiting that bearish pattern of volatility. I think that will occur most of this week. I told you today's volume or trading range, is relatively small. Let's go to the 3 green arrow chart. So you had a little bit below average, 93 million on the volume, 10 points, a little bit above average there. So when you look at these numbers and relative to their averages, 10 points is a little bit above average, and then the 93 millions is just a little bit below. So both numbers are still relatively high, and the ATR relative to the price, normalized ATR, I guess you can call this, is at 2.5%. So that's still a really high number. It's still a pretty bearish number. They're both still rising. So we need to get a little bit more of a declines before we can really feel good about, again, the beginnings of an intermediate rally starting here to the downside. I've been showing you on-balance volume on the moves to the upside. We talked about how that was a colossal failure of on-balance volume when we crossed above that 50% because we didn't even come close to where it was when we crossed below it. So we still continue to have volume issues, right? We're still, when you look at where we're at now relative to where we were in some of these other days, back in here where we had closed. We're still below these levels. So, I mean, it's a great little rally the last couple of days. So you can see down here where we are. It's a great rally the last couple of days, but we're still not confirming the bullishness with volume. And this is normalized on balance volume, right? Because it's money flows, so it accounts for the change in prices. So it should confirm it. It's been confirming on the way down. It's not confirming it yet on the way up. That's why I still think we're more than likely going to push down before, again, similar to this, before we make one last intermediate run as this bear market starts, right? Bear market starts with 3 intermediate rallies. We've had 1, 2, we need 1 more, and then the bear market really gets going in earnest. All right, now let's take a look at what's driving the price action today. And you can see the biggest loser here over the last few months has been bonds now, real estate and bonds. Those are not the 2 things you would think would be biggest losers over a certain period of time, an extended period of time, these hand in hand. But that's been the case. The yields have been up, the dollar's been up, the commodity's been up. That's your 3-headed monster, like I've mentioned before. For the entire year, those have been the 3 things. Yields are higher because of the opposite of bonds prices. Dollar's up, commodities up. And the dollar just continues to march higher. And all these things continue. The yields were up a smidgen today, 3rd straight day, and only 1 down day in yields in the past week and a half or so. MACD is back above its moving average. Probably not going to extend too much higher. The dollar is down, but still sitting on a 17-day moving average as the MACD breaks its moving average. So you have an opportunity finally for some kind of reversal here, but keep in mind the long term, you're still way up above the 17-week moving average, and the MACD itself is still above its moving average too. And then finally, the major commodity price. This has been the big story, right? This is what's going to either break inflation or at least be a reflection of inflation breaking or not. As we still kind of hold up here at the same levels we were when Ukraine was invaded. But you can also see there's nothing below. So if it falls, it's going to fall pretty decently because there's no volume here. But it also goes to show that if it falls, then you can see here too, then that's going to be a big, like it doesn't fall this much without a complete destruction of demand. And that's not necessarily bullish for equities. That's more a reflection of a much strong slowing economy. And that's kind of what you're seeing here. So you almost, like market bulls kind of want commodities to stay bullish because that means the economy is still using them, but just not at extreme highs. Just don't get above 30 again. Get up here in the mid-20s and just kind of hover here and into this area and just not go anywhere, go trendless. Because it's pretty much gone trendless now. If you look at its trend strength indicators, there's no trend going. If you look at the weekly version, we had such a bullish trend going, it's gone, right? So that's not the case for the dollar. The dollar's trend still going strong. The trend for bonds are still going strong. You look at like real estate, it's got a very strong bearish trend going, but commodities do not have a trend going at all anymore. So that strong trend has broken, even as another strong trend, and again on a long-term basis, a weekly charts, another long-term trend is going in equity. So again, we kind of needed to break through this cloud and get a bearish trend going. Otherwise, if we kind of break back up above 23% retracement, get back into this noisy area, no more retracement, but not necessarily push to new highs. And I think that's a good bull case. Of course, if we break down, then that's going to be a sign of, again, demand destruction. And if we spike back up, then that's going to be, you know, a sign that inflation is not gone, that Fed will still continue to raise rates, even as currently the terminal rate, as you can see, for February, it's actually for February expiration, you're looking at about 80% odds of a hike up to, I said 97% odds of 75 basis points, but you got about 79% odds of a rate hike, 77.8 of a rate hike of a 5% rate, 5% or higher. So that's what that's what the market has been pricing in. You can see the yield spread is still very negative. It continues to be really, really negative as the 10-year itself hovers at 4%. Now again, if we're going to get the 5% on the Fed funds rate, then you're going to get the 5% on the 10-year yield too. But again, you'll see like rising yields is not bullish for equities. It's actually bearish for equities. So if we do make a run to 5% from 4, then you can see what's going to be probably the beginnings of the bear market in terms of a catalyst. What will actually break us through that 200-week moving average and break us through the 200-week moving average and get us going to the downside. Because remember, again, it's kind of hard to be bearish in a bear market when you're sitting at the average prices for the past 4 years. That you're simply just average, right? Especially when that average price has been rising as much as it is. You're currently sitting at 2%, 1.97% above it. And like I said, that average has been rising over the last 4 years. So it's not like the 4-year average is a bad number. It's actually, 4-year average is actually a really good number because of how much it's been moving higher. And yet we're sitting right at it. So it's, kind of hard. I mean, you look at over the last 2 years, you follow my cursor to the left, and you can see that we're above all these other prior year peaks. The only peak we're not above is 2021. So it's and just a little bit below the 2020 peak at the end of the year. So that doesn't say as much about the bear market we're in. It says more about the rally we had in 2021. That it was just way too much. There's this idea from Mohamed El-Erian, I think it was Mohamed El-Erian today, that said that the Fed needs to be held accountable. That the Fed has made these policy errors and they're not. Well, nobody talks about the Fed making policy errors up here. See, the problem is the Fed's policy errors occurred up here. And when the Fed makes their errors, nobody wants to hold them accountable. In fact, nobody wants to hold them accountable until they're feeling the consequences of those errors. But nobody wants them to break that bull market. Like that's 45% above the 4-week average price. That's insanely bullish. There's only been 2 other times in history we've been that bullish. The late 90s and then going into the 1987 crash, Black Monday crash. That's the only 2 times ever we've been that strongly bullish. The Black Monday crash brought that back to average very quickly. And the 1990s, it took through a bear market of 3 years to bring it back down to normal levels. And so that's the policy error, but nobody called for the Fed to be held accountable then. They're only calling for it now when the S&P is at its average price. Imagine if we were below average, which is what happens when you are in bear markets, right? You get below average, the average being the 0 line. So you get below average in bear markets. That's the problem, right? The problem isn't being average. That's not a bear market. That's not the Fed doesn't need to be held accountable because average prices are at average. They need to be held accountable because prices are too high, and they let them get too high, and they didn't want to break that because nobody wants them to break that. They only start thinking about the Fed doing something wrong when the market has corrected the froth, right? And all the froth is out of the system. And that's exactly what's been going on in 2022. Let's take one last look here at the sectors and how they performed today. And you can see everything's down except for energy stocks. But if we just look at here today alone, so let's look at just October 17th. You can see the biggest losers were staples, healthcare, and energy. Those are your 3 biggest losers. They lagged behind the market, whereas discretionary and real estate were your biggest winners, along with technology and communication services. So your 3 big winners, as well as real estate, were your biggest losers. Now keep in mind, this is the reason why those were your 3 biggest. There's a reason why those are your 3 big winners, because they are the 4 biggest losers for the year to date. So not surprising that they would rally, whereas energy, staples, and healthcare are your biggest winners for the year, and including utilities, which also had a little bit of a bounce, but utilities in those areas are your biggest winners. So not surprising they lagged, and it's a one-day phenomenon. Now we'll see if that continues. Again, pushing the market above 3,800 with that leadership, starting a new intermediate rally would be a very good sign that ultimately this has just been a correction, not the beginnings of a bear market, but just a correction. I think that's a lower probability, but we need to see more of today all through the end of the week and then some going into next week and break that resistance, then you're going to feel really good about that Tom Lee rally going probably now into the beginning of next year. All right, now let's take a look at our trade idea of the day, and I'm going to take a look at Netflix. Netflix has been something that's been on our radar previously this year. Had a really good gain today, up almost 7%, 6.5%. It was up 7% at the tops of the day today. The near-term line made its way into bullish territory. It's doing really well. We're almost 5.5% above the moving average. So you have a green line. You're far enough to get that line moving higher. You have light green shading because you're not quite above 50 yet, but it's a good move. The momentum line is down simply because we're off of the high of the day, but you know, a good range, above average range, pretty decent volume. When you look at the 3 green arrow chart for Netflix, you have 3 green arrows here. You have above more than 1.5 times the average volume, so really good breakout opportunity. You can see the moving averages are sitting all on top of each other right now. The 8, 17, 30, 50, I mean, they're all right there. I mean, and we actually gapped through all of them today. We finished down below the 17. We gapped open above all of them, and then this ran away from the open. And you can see not only the moving averages at that price, but so is the point of control. There's no volume ahead of us as we potentially start to fill in this gap right here at about 250 and higher. MACD crossing above its moving average, stochastics crossing above its moving average. You look at the DMI, we're close to crossing above 25 on that positive indicator, well below 20 on the negative. Looking at the RSI and the CCI, they're moving up towards the top end of their ranges, getting up towards bullish territory. Looking at the Ichimoku cloud, we are above the cloud, easily above the cloud. We don't have a trend going, but we are above the cloud. So there's an opportunity to move out. The price is above where it was 26 days ago. Looking at the Bollinger Bands, we are into the upper quartile, not breaking out yet. Very flat bandwidth, so look for a breakout to occur within this week if we are indeed going to be bullish. So what I decided to do on this trade is, instead of going too strongly on the bullish side, I decided to do a bull put spread. So selling to 230, it was right around the mid-30s delta when we got into it. Selling to 230, buying to 225. Earnings is coming up here pretty soon. So what I decided to do was go for a normal return for a little less than 2/3 of my normal risk. That way, worst case scenario, I lose the same amount of money, but my goal is to lose the same amount of money, 350. But my worst case scenario, if it really gaps strongly against me, I can't lose more than 2/3 of what I normally risk. So that's a good, or just a little bit less than double what my goal of my reward is. That's a good thing, just in case things go really haywire and move to the downside. But if they continue to break out to the upside, then we can get 50% max gain relatively early or more, and then put this plus a little bit more at risk on a new trade, potentially even on Netflix. Put it together on a new trade, and then try to get 1.5 times my maximum. And then avoid the risk of the earnings in that scenario. So that's our trade idea here for today. All right, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread there with any questions or comments you have. Apply to anybody else's thread. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Have a great rest of your Monday night, everybody, and we'll see you all next time.